Okay, we're ready to roll. Welcome, and thanks for hanging out with Jordan and I for a deep dive info session on mortgage options for self-employed business owners, freelance workers, gig economy workers, any number of, let's call them non-traditional mortgage financing loan programs to purchase a property either as a primary residence, as a second home, or an investment property. So we're going to cover a few different things and examples of programs. We're going to relate these kinds of programs to the three pillars that Jordan refers to often on these sessions. And then we'll open it up for Q&A or scenarios, things of that nature. You can use the chat or you can use the Q&A box. Either way, we will do our best to monitor. If you're watching this after the fact, you can comment on whatever platform you may be watching it, or you can reach out directly. And for those of you wondering, the replay or recording of this will be available immediately afterwards at the same link that led you here. And then we'll, of course, get this on our YouTube channel, Wake Up Real Estate, and on our website, wakeup.realestate. Jordan, mortgage options for self-employed business owners and freelance workers. Let's talk about the three pillars and how that relates to these types of programs.
So, yeah, I mean, we reference this a lot, but three pillars are going to be income, credit, assets. Okay. Typically these programs we're missing a pillar or two to where we can't qualify them on traditional means, aka conventional VA, FHA products, and we need to do what we call non-QM products. And I like to put them in a bucket, and that's why we're kind of doing this. This call is self-employed borrowers have quite a bit of different products they could use as a vehicle to get them the home financing that they need.
Yeah.
And a lot of them don't realize what options are out there. I mean, there's at least 4 primary residence options. And the way I look at these pillars and how I reference them, credit, income, assets, is usually we can't qualify income is usually the problem. And we need to
in the traditional way.
Yeah,
we can't qualify it in the traditional way that we would.
Yeah. So this is for really, Josh, you're self-employed in some aspect. I'm self-employed in some aspect, and probably a lot of people on this call are self-employed in some aspect. I don't recommend necessarily paying a bunch of money to the government in taxes, right? Even though that we need them to qualify for traditional loans. A lot of times there are products out there that are a little bit higher than the market that these self-employed buyers would, I wouldn't recommend they just, claim that they're making a ton of money and paying a bunch of taxes so they can qualify for traditional. So these products are designed to get around those tax calculations. They're designed to be calculated in a way that will use other means to calculate them, or no means at all. That is an option as well. And so when I'm looking at it, usually credit on these are going to need to be a little bit higher. Okay. Typically.
So let's qualify that. When you say a little bit higher, just for
so I'll give you an example. Okay. 10% down for a traditional product, like on an FHA, will go down to a 500 credit score. There's no bank statement product that's going to go down that high. If we're doing a bank statement 10% down, they might go down to a 620, for instance, maybe a 640. And with lower with higher down payments of 95% loan to value or 90% loan to value, they're going to require even a higher loan to value, right? So 20% down, you might see a couple 580s. It's a little bit of a give and take. The more money down, the lower the credit score would
risk go. Reward is what the lender is calculating. Risk reward.
Correct.
Right.
So I usually, if a client doesn't have a really solid credit score. When I say solid, really above 680, is what I would consider a solid credit score, 660. They're typically going to be at least 20% down on these products, and
Okay, so hold on. For those confused, so theoretically, Jordan and I get emails routinely throughout the week. Theoretically, there are bank statement programs available for folks with a 620 plus, 640 plus, 10% down. However, there's again, risk reward. So that may come with a higher rate or other factors that make it harder to qualify for. So the point Jordan is making is there are many more options available at 680 plus, 700 plus, 720 plus.
Yeah, you can get it done at 620, right? You might just have to put more money down, right? Or take higher interest rates, or or have better income ratios. Maybe they have a smaller ratio, a smaller ratio than normal, right? Very competitive, essentially. In the terms of assets, they're typically on these, they're going to require some sort of reserves as well, right? They're going to require the down payment and then reserves. And what the reserves are going to be whatever the monthly payment is, okay, times, if it's 6 months reserves, it's 6 months that you have in the bank to make that month, that payment.
So for round numbers, let's say we're doing 10% down on a $200,000 house. That means they need 20% down. And let's say it's $2,000 per month. Again, just trying to keep it round for everybody. That means they also have to have 12,000 in reserves. 6 times 2,000, 6 times 2,000, 12,000 reserves. Am I tracking correctly, Jordan?
Yeah, absolutely. If it's 6 months, sometimes it's 12 months. It depends on, again, it comes in where it's like, think of it, a lower credit score is going to require higher reserves, right? There's a give and take on these, to where some banks will do a lower credit score with higher down payment. Some banks will do a lower credit score if they just have more reserves. They don't necessarily need to put more money down.
And how can a borrower, what are different ways that borrowers can demonstrate reserves other than simply money in a checking account?
Retirement accounts, sometimes insurance policy, some certain
cash valued insurance
policies. Okay. I've done it where people get gifts for the down payment, and then the down payment they had turns into reserves. Right? I know that's a little odd way of thinking of it, but you could do that technically, right?
Stocks.
I mean, really anything that you can liquidate is going to be considered something that could be used as reserves. Doesn't mean we have to actually liquidate it either. We just have to get the terms of the liquidation. So, for example, if we're using a retirement account to use as reserves, we got to get the terms and conditions of the withdrawal. So, typically, a safe number when I'm qualifying someone, obviously, I'm not going to make them go run down the terms of withdrawal right at in the first 2 seconds. I ask them how much they have in their retirement account, and I use a 60% ratio. Typically, most places are not going to tax them over 40%. I've never seen that number. That's kind of a conservative number. And sometimes when we can't get the terms of withdrawal, banks will just use that number. That's kind of the standard.
Okay. So and I know we're getting into the weeds a little bit here, but some of this is just so you can have an intelligent conversation and be knowledgeable enough to maybe overcome an objection or a misconception that a borrower might have, things of that nature, right? You don't have to know the nitty-gritty guidelines per se, but just be knowledgeable and educated enough to have a conversation with someone if or when you use some of the ideas or just the simple fact. When you use this to create conversations, when you use the fact that, hey, if you're self-employed and been trying to buy a home but haven't been able to, we might be able to help. Stuff like that. Okay. So we talked about credit. We talked about assets. And we've talked a little bit about income and how we demonstrate that in a non-traditional fashion. So There's a couple of
I want
different.
to yeah, I want to deepen on that, because that's really what the loan is about, right?
Right.
It's not the other two. Typically they have, okay, at the end of the day they have typically credit. You know, when you run across these buyers and like, hey, I don't qualify for a loan, it's not because they have low credit scores. Usually it's because they've written, when it's a self-employed borrower, they've written all their taxes off per their tax accountant to save them the most money they can. So
yeah, keep as much as possible in their pocket.
There's quite a few different programs that income portion can be satisfied with. Let's start with the easy one. I'm assuming most of the people on this call are realtors, and most realtors are paid 1099, right? There are 1099 programs out there that will just take your 1099 from the year prior, and you're in the you know, a 2-year history of 1099s, and they'll average them. It's as simple as that. Right.
It's funny that you mentioned that, because I got my 1099s in my email this morning from eXp Realty.
Yeah.
Very
so
timely.
With more money down, again, right? It's not like a traditional, it's not like they're going to get the same rates as someone that's W2, you know, at the
You're
end of
not
the
going to
day.
get FHA 3.5% down and be able to get down payment assistance.
Correct.
It's just
It's
not
going to be
reality, right?
closer to 10 with a little bit higher credit, you know, 10% down with a little bit higher credit score. But that is physically, when you're talking to a contractor, for example, a lot of contractors are also paid 1099. We can get their 1099s and average them. I'll give you another example is sometimes car salesmen are 1099. You know, there are groups of people that you can target, not chase after, whatever you want to call it, however you want to call it, that you can present these options to and say, hey, if you're struggling to qualify because you're writing off your taxes, don't worry. There's 1099 products, and we'll just average your 1099, for example. And that's just one example.
So here's this is just a little marketing side note, right? If you want to attract this audience to you, talk about the audience, not the program. And what I mean is, if you craft a marketing message, you want to be around, hey, are you a 1099 employee, or are you a do you have 1099 income, versus, we have a bank statement program. Like, don't talk so much about the don't talk so much about the program. Talk to the person, like the niche that you're looking to serve, and then you can tease the program, right? But hook them in with, hey, are you a self-employed business owner here in Central PA? If so, we have 3 unique mortgage financing options you may not be aware of.
And then this kind of gets to my point too. There's other products out there that would fall under the self-employment. Technically, Josh, you're self-employed, right? I think realtors more look like themselves are self-employed, but car salesmen don't. Like, when I've talked to car salesmen on 1099 they don't say I'm self-employed. They say I work for Chevrolet, right? At Chevrolet over at, Don Hatton over off the Kellogg, right? They say I work for that company, right? But they might be 1099 and they're actually self-employed. So where you're if you're targeting that audience, it'd be more, are you a 1099, you're targeting that word, verbiage, where self-employed borrowers are mainly going to be like people that actually run. That's what I've experienced, is that when I'm marketing to self-employment people, I got self-employment borrower loans. I'm not going to get the car salesman, right? I'm going to get that mom and pop shop that's going to come to me. So you got to kind of, to my perspective, is you dive a little bit deeper and go and whoever you're talking to, you need to make it more towards them, like you were saying.
Yeah. Hook them in, right? Hook them, get their attention. The audience that you're trying to attract or serve, get their attention first. Get them nodding along. Oh, that is me. Are you a car salesman here in Central PA with 1099 income? Did you know that we, have 3 unique programs that can help you buy your first or next property? Let's chat, right?
This is a little off topic, but you'll be surprised on how many car salesmen or originators think you need 1 year of commission, or need 2 years of commission, right? And some car salesmen are W-2'd, okay? Like us, like our originators, we're W-2'd. We're not 1099 in most cases. When you're W-2, you only need 1 year commission. You'll just pick up clients that fall in that category because they think they need to wait, and they
Yeah.
don't need to wait, you know.
Yeah.
But still the same concept, a little off topic, but
Okay. So the income pillar, we have number one, we have 1099 as a way to verify income as option one. Option two, we've talked about it already, but we'll reiterate.
bank statement. Yeah, bank statement's going to be an average of 12-month bank statements or 24-month bank statements of deposits and average balances. They'll average that and they'll use an expense ratio of 50%. So if I have a bank statement, for example, and there's cases where we can use a higher expense ratio to where we don't cut their income down as much. But let's say I have a business that's grossing $200,000 a year. I would be able to use $100,000 of that income.
And when you say grossing, you're saying that the bank statements state that they grossed on average for that 12 months, 200,000. It'll get slashed in half.
The normal is to slash it 50%.
Okay.
For most banks. Now,
and
you
what
can
would
get
be an example of where there would be an exception?
A letter from a CPA saying that
Okay.
their expenses only account for 10 or 15 expenses of it. If they don't have storefronts, maybe they run the business from their house. If they don't have inventory, there are situations where you can do higher expense ratios. Just depends on what that business is, and we call it a narrative. That business narrative. Every bank statement loan, or really any self-employment loan that we do, we get a business narrative that would tell me about their business. What does your business do? What does it sell? Does it have inventory? Do you have storefronts? Things like that. And if you don't ask for a higher expense ratio, you're not going to get one. Okay. I'll answer Alexis's question here.
Yeah, there's no stupid questions, right?
Yeah.
So ask away.
I'll answer this
Alexis,
question.
we'll address your question in a minute. But please, if you, as we're chatting through here and sharing things, if you or when you have questions, drop them in there so that we can address them in time.
Yeah. So if we get a CPA to corroborate, like, hey, their expenses are really only 20%, we'll only use that 20% expense ratio. But the lender has to agree. These aren't like traditional loans where we run systems and it's just a yes or no kind of thing. These are all manually underwritten. So the lender has to say, yeah, I would agree that expenses are probably 20%. So we'll use a 20% ratio.
Well, this sounds, Jordan mentioned something here that I want to emphasize. It sounds simple, right? But there's an actual human in these scenarios that are reviewing and underwriting, approving or denying, versus in more traditional fashions, it's literally like computers and algorithms in many cases that are spitting out a yes or no.
Yeah. I was trained by an underwriter of 20 years. So I think for me, and this goes into when we're putting these together, we're painting the best picture we possibly can for those people. Yeah. I wouldn't want to present anything I don't want to present, right? So at the end of the day, anything an underwriter sees is I have intentionally allowed them to see, to paint the very best picture I possibly can for that client to get approved for that home loan. And you just have much smoother transactions if you treat it that way.
Yeah, you're presenting in
like,
the best light. Presenting,
yeah,
you are taking and emphasizing the glowing pieces of the file, right?
Yes.
And
letters of explanation.
Here I will give an analogy. My oldest son is a junior, and he is now starting to get offers, scholarship offers. And the first one we got, it gave example of additional academic money available. And it was GPA and SAT scores, but you can take the SATs, and if you do poorly, you don't know, they don't have to know. You don't have to report those, right? And my point is, we're not going to present something that makes the borrower intentionally look, we're not going to present the negative aspects of it, right? So if it strengthens their case, it'll be presented. And if not, we'll find a way to creatively work around it.
Yeah.
Is that fair?
Yeah, absolutely. Yeah.
Yeah.
So Alexis asked, sorry if my friend has an LLC and is an S corp and pays herself biweekly, so she is W-2 then, or would it be based off her business income? It's both. So what you're talking about is qualifying someone for a traditional loan. Okay. She is W-2, so we would be able to use that income if there's a history of W-2 there. But also if the business is losing money and she's paying W-2, you're going to use the loss against them too. Now, the products that we're talking about here today is we'd actually throw those tax returns out altogether, for example, and possibly qualify them off the business bank statements, or a P&L, or a no ratio loan. It just depends. But anytime I have a self-employed borrower, no matter who it is, I always get their tax returns. I'm not going to turn them in, okay, but I'm always going to get them. So I can see if maybe another loan officer made a mistake. A lot of people don't realize if you have a Schedule C, most, Josh, for your real estate business is probably Schedule C, but if they have a Schedule C, if you put your stuff in depletion and depreciation, lenders can add that income back in. I've almost had everyone write off depreciation depletion, for example, and then I have one loan officer say I can't use the income, when in reality you can. So Alexis, to answer is I would always want to look at their W-2s that they're paying themselves and their business to see if we can use it to qualify them, traditionally, because the down payments would be less and the interest rate would be less. But if that doesn't work, this call is literally about how we can get around that by using the bank statements or 1099 income.
And I'm going to give ourselves a shameless plug here. One of the big benefits of referring clients to our group here, Jordan and I and our team, whether it's yourself or your clients, is because, or in part because of all of the lenders that we have access to, and also Jordan's expertise. He is incredible at looking at all the puzzle pieces and then putting it together in the best way possible for the end goal for the client. And this is a perfect example of this friend of yours. There are theoretically, just from what Jordan read here in 2 sentences, there's already multiple ways that the puzzle pieces could be put together, depending on what the numbers look like. Like, how much W-2 income is she paying herself from the business? Yeah. That alone may do it, right? Or
and I'll give you an example of that. If someone just looked at the business tax returns and showed that they were paying themselves, they were netting zero, for example, they're netting $0, but they were paying themselves $100,000 in W-2, they have $100,000 in income you can use to qualify. But if someone didn't do all the research necessary for it, they could tell her no and be telling her no off something that they just didn't get, have access to. So with that being said, no matter what, if it's a self-employed buyer, if I know I'm going bank statement, I still gather those tax returns just in case. You never know. I never let my work be determined by what another loan officer has said.
Yeah.
There's been time and time again where I've taken loans where other loan officers said no to, which I know for a fact they could have closed just because I presented that in a certain way. I painted the picture in the right way.
1099 bank statement. How else can we verify income in these?
There is a loan called a no ratio loan. Okay. It's for primary residence. It's basically you don't have a job. We actually have one under contract right now, Josh. That it's 20% down. It's at least a 700 credit score. The rate is not good, and there's usually points attached to it. Okay, but there is a loan out there with, if you have 12 months reserves, 20% down with a 700 credit score higher, that you don't need a job. There's just no income calculated on it at all.
So by no ratio, we're literally saying there's no employment, no income. Like literally,
I leave it blank on the application.
In that case, that one of those 3 pillars, the income pillar, literally is irrelevant. It's not for everybody. And as Jordan mentioned, 700 plus, must have 12 months reserves, and must have 20% down if it's a purchase.
To give you an example, on kind of a rate, what you're looking at there. Usually on these are a point to 2 points higher on bank statement loans than a traditional loan. So if traditional loans are 6% right now, you're looking 7 to 8 usually. On a no ratio loan, you're looking at low 9% with a couple points, 3 points attached. So at the end of the day, it's an expensive loan. It really is. It's an expensive loan, and I try to explain that to people and make sure they understand. So I try to
But it can
exhaust any
still
other
be a
options
good
first.
option depending on the situation,
Yes,
you know. But yeah, it's a
there have been
trade-off, right?
situations where people just did not have it because the way they had their taxes or income was under the table or something like that. I mean, there's ways to do that there.
And I'll share this because he doesn't mind us sharing, and we've shared it before. But Ryan Hartman, who I do the Wake Up Real Estate Show with, he did a no ratio cash out refi last year to take the cash to purchase a second home.
Mm-hmm.
It was a higher rate, but it made sense for them, right? So it's all about matching the goal of the client with what is available and making sure that financially it holds up and will work for them. Before we get to
Alexis has
that,
another question.
can we get to the fourth? Because we didn't really talk about P&L, right?
Yeah,
So
we'll get to the
we have
P&L. This is the last
1099.
really primary residence a product anyway. P&L, it is just a sign letter. It's a P&L. It could be on one page. It doesn't have to be anything extravagant, but a P&L from a CPA signed and dated, stating how much money they make. Right. So that P&L could be made. It just has to be from a licensed CPA.
Right. It has to be prepared by a licensed professional, not just something you drafted in a Google spreadsheet.
Yeah.
So 1099 bank statement, P&L, and then we have the no ratio, no income, no employment verification, where as long as the other two of the three pillars are strong.
Those are probably the easiest in that order too. We start with
There you
bank
go.
statement, 1099, no P&L, then ratio.
Okay. So bank statement is easier than 1099.
Oh yeah.
Oh, I see. I'm learning here now.
Yeah. Well, it's not that it's easier, it's more competitive, right? You're
Okay.
actually, it's if I'm presenting a product to a client, right? We don't want to scare the client off, with higher rates and stuff like that. We want to be we want to do good by them, right? We want to help them get the lowest rate no matter what. I don't want to just stick them in a product. So bank statements are usually the better product on interest rate and other things. But with that being said, we're going to compare and contrast, right? It's like if they're 1099 and they qualify for both, here's both options.
Before we get to Alexis's question, what we were discussing was primarily primary or secondary. I want to loop in a topic that we've talked about in past sessions, and we'll talk about more in future sessions. But if we're talking about an investment property, non-owner occupied investment property, DSCR would also be considered a sort of a more business purpose or self-employed business owner type of loan, in that it is using the income of the property for the verification of income. So for that pillar, it's using the income from the property. We still need the other two pillars, right? We need to have, we need to look at the credit score. We need to look at the down payment. We need to look at reserves, right? But from the income perspective, it's going to be based upon the income from the property. And there are ratios on that. DSCR ratios 1:1, 1.2, 0.75. There are examples of no ratio there as well, but
no ratios too.
Yeah.
But yeah, it's a really good vehicle for investors, right? Even with the BRRRR strategy, cashing out, buying a property, remodeling it, cashing out. There's I mean, we can get into it all day, and that's why we had a whole session about it.
Right.
But that is another product that traditional income, we don't have to use the tax returns to qualify them. So we have a business person that's buying property, it's not going to be an issue, and it's something that we could absolutely do.
And we have recently brought on a specialist in these types of loans. So if you'd like more information or like to explore them for yourself or for a client, reach out to Jordan or I, and we can get you, we can get you connected with Taylor on our team to explore those. Alexis asks, is there or are there options for non-citizens?
Yeah, on the bank statement side, yeah. Mm-hmm. There is. It depends. There's a couple different ways we could do it, but yeah, I'll give you an example. If it's an investment property, LLCs, you can buy inside an LLC, for example.
Yep.
But if it's a primary residence, I'm pretty sure there's bank statements for I-10, bank statement I-10s you could do.
Yep. Well, at least there are lenders in our inbox saying
that
that
are
they
selling
can.
it.
So,
so at the end of the day, there is a product for it. We don't run across them often, but
yeah.
it is something that is doable, I think.
Yeah, we have programs for foreign nationals, ITIN, and unique other ways that they can take title to properties theoretically. But anytime, this is very important. Anytime you get into more of these creative options, and I think we're pretty transparent on this, with the increased complexity comes with increased complexity of getting the deal done. Okay. So in most cases, the more complex the more complex the puzzle pieces are, or the smaller they are, the harder it is to put it all together. So the point is, in those situations, we're going to ask for patience, and we're going to ask for compliance as best as possible when providing the documentation that we need and things that we need to keep it moving along. In some of those cases, we're working with lenders that we don't do a lot of business with, so we don't have as much a track record. Just some patience is all. Yeah. Other questions or scenarios or things that maybe weren't clear about some of these programs that we have available? And if not, I think we're going to keep this short and sweet, because I do have a hard stop in about 12 minutes. I have to go meet some clients for a final walkthrough for settlement this afternoon. So that's fun times. Well, it looks like Jordan did such a good job that there just aren't many questions. So we're going to come in for a
chalk
landing.
it up to that. That's fine.
Yeah, we're going to come in for a landing, and I'm gonna do one thing here. I'm going to share my screen real quick. For easy ways for you to connect with Jordan or I. If you have more questions, or you want to go over a scenario specifically with either or both of us, one or the other, all of our contact information is on the screen here. If you scan the QR code, I believe the one top right is information and a brief overview of our dual license program or setup, where you can be dual licensed mortgage and real estate and earn referral fees on that business. For example, I mentioned that I have to leave because I have a final walkthrough. Well, these are clients that I help them purchase the home, and our team help them with the loan as well. If you'd like to explore that, you can scan that, or just go to wakeup.realestate/relo, RELO, wakeup.realestate/RELO. If you have a scenario or a client that you'd like to refer to us, our contact information is here, or you can scan the QR code bottom left, which will take you to a spot where you can create an account and start an application if you or a client is ready to take that step. And one other thing I'll mention that we can do, and several of you on here we've already done this for, we can create a co-branded link that you can use in those situations. So if you'd like to be able to more easily refer clients, you're having a conversation or you're out at a showing, whatever the case may be, we can set you up with a link that is co-branded, that when the borrower goes, they will see my name or Jordan's name, and they will see your name and your smiling face and your information as well, co-branded together. It's an easy way. They can create an account, they can start an application and get the ball rolling there. And oh, by the way, this is kind of in the weeds, but it's related to this topic. If we're going the bank statement option, Jordan, what's one of the first things you're going to do If we're trying to go the bank statement route, we need the what?
Bank statements.
The bank statements, right? So we're going to review the bank statements before we go pulling credit or ordering appraisals or anything else, right? We're going to take a look and
We'll have
say,
them calculated. We actually send them into a lender to be specifically calculated. So it's not even, I don't even, I can calculate them. That's fine. But they're very quick typically on these. I mean, we usually get those calculations back within an hour or two. That will give us the idea. And then we can kind of work it backwards, see if they're barking up the wrong tree on how much they can qualify for.
Yeah. So we appreciate you all spending some time with us here. Hopefully this was helpful. And we would love to chat with any and all of you. If you have questions, if you want to explore the dual license program, if you want to understand some of these self-employed options a little bit better, if you are looking for a DSCR loan, for example, because you're looking to start or grow an investment portfolio, whatever that case or scenario is, our information is in the chat. It should also be in the description if you're watching this after the fact. You can scan either or both of these QR codes to get more information about the dual license or referring a client. And Jordan, appreciate your time and expertise as always. And we'll be back next week with another info session. We should be back to our regularly, easy for me to say, scheduled time of 1 Eastern on Tuesday. And we look forward to hopefully helping many of you in the meantime as well.
All right.
Thanks all.
Thanks, guys. Bye.